faithfully conveying value, interpreting great books from around the world. Hello, this is Sally's Book Club. Today, I'm going to break down this book called Den of Thieves for you. Its subtitle is The Wild Rise and Fall of the Largest Insider Trading Network in American Financial History. From 1980 to 1990, that 10-year span was the golden age of American finance. Back then, the stock market kept climbing and the economy was booming, but it also bred the largest financial crimes in U.S. history. A bunch of Wall Street folks leaked trade info to each other in advance, weaving this huge insider trading network to make insane profits. The collapse of this network directly led to new U.S. securities laws and indirectly caused both the 1987 U.S. market crash and Japan's 1989 stock disaster. The author James B. Stewart is a veteran journalist who's written for the New York Times and the New Yorker, known as a reporter's role model for his deep dives into major U.S. business, legal, and political events. His book, Den of Thieves, details how this insider trading network ran wild and got busted. This wasn't just one case, but multiple independent schemes by various Wall Street players. By profiling four key figures, the author shows how they got rich through insider trading, then landed behind bars. One main culprit alone paid personal fines totaling $1.3 billion. Now, what's that equivalent to? 9 billion Chinese yuan. For 20 years since publication, this book's stayed relevant as the definitive read on financial crime. It won journalism's top Pulitzer Prize, made Forbes' 20 most influential business books, and got named a Fortune magazine must-read. How did these four central figures weave their insider trading web on Wall Street? How'd they walk off with at least $3 billion? And how did their empire finally crumble? Let's dive into Den of Thieves together and explore this money-grabbing frenzy. 1980s Wall Street was this freewheeling paradise of capitalism. President Reagan hated market regulations, believing any market action was justified, so financial dealings ran wild. Even when crimes happened, only one or two unlucky guys got nailed while others walked free. This bred rampant crime on Wall Street. People got bolder, with insider trading as the signature crime. What is insider trading? It refers to financial professionals buying or selling stocks based on inside information or helping others do so. For example, in a merger of listed companies, if Company A wants to acquire Company B, usually Company B's stock price will surge. If you can hoard Company B's stock before the announcement, then you can make a huge profit. In other words, the news that a company is about to be acquired is the most valuable, but according to regulations, staff directly involved in such deals can't buy stocks of the related companies. So they find ways to leak the information to their friends. And if friends have similar info, they share it back. This was seen as the essence of friendship among many Wall Street folks. Mutual benefit through insider tips. Of course, this is illegal. They destroyed fairness in the securities market, but since there was little oversight, everyone from Wall Street sharks to small fry were engaging in this self-enriching scheme. Let's start with a story about a small-time player making money. The protagonist is Dennis Levine, who graduated from City University of New York with average grades. On Wall Street, filled with Harvard graduates, he was a typical rookie. After college, he sent job applications to almost every company before landing a job. But he never stayed long at any job. He was often fired or quit. Well, because his math skills were terrible. Worse than interns, colleagues looked down on him. Moreover, he was idle and often skipped work. Amazingly, despite this, he lived much more lavishly than most colleagues. He and his wife dined at the fanciest restaurants, drove sports cars, bought art by Picasso and Rodin, purchased a $500,000 house, spent another $500,000 renovating it, and boasted about their $1 million mansion everywhere. But his annual salary was at most $500,000. So where did the money come from? The answer is insider trading. Shortly after starting work, Levine figured out this lucrative path. At work, his main focus was on building his insider information network. First, he opened an anonymous account at Roy Bank in the Bahamas to secretly trade stocks with inside information. Next, he actively sought out his informants, exchanging insider trading info from their companies. Through smooth talking persuasion, he found 3 people, one former colleague, one ex-intern, and a lawyer, all with access to different merger deals. Generally, they communicated via coded phone talk, sometimes meeting up at spots like benches by lakes and city parks. His insider network kicked off fast. A typical move involved an informant hinting he should buy shares of a certain company. Sure enough, days later, the company announced a merger, stocks soared, and Levine raked in easy cash every time. By the time he got busted, Levine's insider profits hit $12.6 million, or over 80 million yuan. But oh, he was just a small fry in Wall Street's insider trading web. The king of the 80s Wall Street speculation was Michael Milken, hailed as the most influential figure in U.S. finance since J.P. Morgan. At the time, he worked at a securities firm called Drexel Burnham Lambert, heading the high-yield department. Compared to Wall Street's old-school financial giants, Drexel's background and size were only second tier. But under Milken's leadership, Drexel's clout rivaled Morgan Stanley and Goldman Sachs, becoming Wall Street's speculative kingdom. Milken's photos are still all over the web. He looked sharp and capable, with eyes like an eagle's. He was born into a well-off middle-class family. His dad was an accountant, and by age 10, he was helping with the work. He graduated with straight A's from the prestigious Wharton School, but he shunned Wall Street's mainstream business and chose Drexel, a second-tier outfit. His pet business was more niche: junk bonds. What are junk bonds? We know bonds are financing tools. Issuers sell them through financial firms, promising to pay back principal and interest at maturity. Historically, 2 big rating agencies ruled the U.S. bond market: Moody's and Standard & Poor's. They gauge a company's bond worth. A or above ratings mean high-quality firms raise funds easily, while many get rated below B. Their business is poor, default risk is high, no one wants to buy these bonds, so they're called junk bonds. These low-rated companies have strong financing needs, but regular financial institutions aren't willing to help them issue junk bonds. Milken saw a business opportunity in this. He studied numerous companies needing to issue junk bonds, carefully uncovering their potential business prospects to ease investors' concerns and doubts. He was a genius salesman with an amazing memory, able to precisely say who issued a bond, how much it cost, and its yield. And, he could accurately predict a company's ability to repay principal and interest at maturity using multiple sources of info. Carrying a briefcase full of research reports, he traveled everywhere, convincing potential junk bond buyers one by one that as long as they held them long-term and diversified, not putting all eggs in one basket, they would definitely get low-risk, high-return rewards. Moreover, he promised that when buyers wanted to cash out, Drexel could buy back their junk bonds anytime so they wouldn't worry about losing money. Slowly, his efforts paid off. His earliest clients were risk-loving businessmen who made money on time through Milken's junk bonds, even exceeding expectations. They became Milken's loyal followers, constantly bringing in new clients. Milken's business grew bigger, and many clients even obeyed him unquestioningly. Actually, Milken didn't really discover a new low-risk, high-return business. The key to scaling junk bonds was his genius salesmanship that made the product liquid. A's money went to B, B's money to C, C's money to D. Fully liquid funds could plug new holes that popped up. He didn't create value, he just hid the risks. Once some companies couldn't repay, the chain would snap quickly. That's why, during the junk bond craze, the Oracle of Omaha, Warren Buffett, expressed reservations about their value and refused to join in. But few were as clear-headed as Buffett. Milken's clients kept growing. Over 10 years, junk bond trading volume expanded tenfold, and Drexel gobbled up almost all of Wall Street's junk bond business. Soon, Milken set up a branch in Los Angeles as his personal kingdom. There, Milken sat at the center of a massive X-shaped trading desk, surrounded by his loyal traders and salespeople working frantically. He greedily scanned trading data on computer screens while grabbing two ringing phones, one to each ear. This was the nerve center of junk bonds. The capital of his bond empire, he was brutally demanding with employees, starting work at 4:30 a.m., eating fast food at desks, and under such pressure that some smoked 4 packs daily, others chewed rubber bands, and some even bit through phone cords. The compensation for all this stress was money. His team earned 5 times more than their Wall Street counterparts. One year, a 33-year-old employee under Milken got a $10 million bonus, more than he ever dreamed possible. But what blew his mind more was Milken awarding himself a $550 million bonus that year, exceeding Drexel's entire annual profits. Yet Milken remained unsatisfied, craving billionaire status. With Wall Street in a merger frenzy, Milken pushed Drexel into M&A deals for faster riches. So, what was this merger mania like? People were frenziedly buying existing companies instead of building new ones, flipping businesses for profit. For example, a former U.S. Treasury Secretary bought a company and sold it 16 months later for a $70 million profit, leaving Wall Street green with envy. Major players like Disney, MGM, CBS, Universal Studios, and Unocal got swept into these deals, some buying, some selling. But most legitimate M&A deals went to established firms like Goldman Sachs or Morgan Stanley. With little room left, Drexel forged a new path: hostile takeovers. Hostile takeovers are acquisitions that proceed regardless of the target company's consent. Normal acquisitions aim to strengthen companies through cooperation, but hostile acquirers typically want quick profits from flipping companies. Specialists in this became known as corporate raiders. They'd amass huge stakes in public companies, become major shareholders, raise capital, then suddenly buy the whole firm to resell at higher prices. To fetch a good price, they might slash operating costs or break up the company to sell parts separately. Many companies couldn't withstand this turmoil, going bankrupt after being flipped multiple times. We can compare a quality company to a running bull. Raiders buy it to doll it up, or even dismember it to sell by the pound. Whatever makes money, they'll do it. Whether the bull is willing or healthy, they couldn't care less. That's the evil of hostile takeovers. They create no value, even destroying it. Drexel realized it could fuel hostile takeovers, helping raiders or small companies raise funds through junk bonds to finance acquisitions. In this process, Drexel made money twice: bond issuance fees and M&A service fees. This turbocharged Drexel's growth. Their annual junk bond conference for client networking grew massively under Milken, often drawing hundreds. At the 1985 conference, Drexel's chairman announced their new strategy: funding hostile takeovers so any small firm could swallow giants. That very night, 4 hostile deals were quietly negotiated, a moment some called a watershed in American business, marking unethical speculation. From then on, the conference was nicknamed the Predator's Ball. Milken declared, "We're coming for GM, Ford, and IBM, making them sweat bullets." Milken wasn't bluffing. He truly wielded power in hostile takeovers. Take National Can Company. Its major shareholder was a corporate raider and Milken's pal. For years, he kept buying its stock until he owned 38%. Yet he always claimed it was just investment, like a wolf guarding sheep. In 1983, when National Can planned to issue $100 million in bonds through a Wall Street firm for sales help, that deal didn't go to Drexel. Milken was furious. He sent the raider to threaten top executives, demanding Drexel handle the bond issuance to save the major shareholders' face. Management agreed. Not only did they give Drexel the deal, but paid higher fees than the previous firm. Yet Milken hatched bigger plans. He urged the raider to acquire National Can, with Drexel funding the purchase of the remaining over 50% shares. The raider then pressured management to cooperate, offering terms. Post-acquisition, he'd own 80% and management 20%. And if they refused, he'd still buy the company, but management would get no shares and be kicked out. Under this naked threat, management caved. Ultimately, with Drexel's backing, the raiders successfully acquired National Can. Drexel earned millions, M&A service fees plus financing charges. Beyond that, Milken created slush funds for his inner circle to speculate on insider trading. Before the acquisition announcement, they massively hoarded National Can stock. After the buyout, they made a fortune. When the raider wanted to flip it, he returned to Milken. Milken brought in another longtime client to buy National Can from the raider. In this flip, Drexel and Milken's slush funds repeated the scheme, profiting again. This was classic Milken warfare. Drexel raking in huge fees by enabling hostile takeovers, while insider trading lined their pockets. Hostile M&A and insider schemes became inseparably linked in his hands. This drew Congress's attention, but Reagan's free market policies let Milken run wild. As Wall Street's top speculator, his insider channels went beyond this. He secretly collaborated with arbitrageurs too. What are arbitrageurs? They specialize in exploiting market price gaps, e.g., moving short-term funds from low-rate to high-rate countries to profit from interest differentials. This carries almost no risk, but the profits are also very thin. Later, they began heavily buying stocks of companies with already announced merger information. Such company stocks rise due to positive news, but since it's public information, everyone knows to do this, leaving arbitrageurs very little profit margin. So many of them started turning to insider trading, binding Wall Street dealmakers to anticipate acquisition targets, hoard stocks, then profit. In short, on Wall Street, arbitrageurs profit almost exclusively through insider trading, like oil stealing mice. Generally, they keep low profiles and get rich quietly. But Ivan Boesky wasn't like that. He was flamboyant, believing anyone who made money was a Wall Street hero. He gave exclusive interviews, spoke everywhere, even lectured at universities, building himself into the arbitrage king. Boesky's fame symbolized Wall Street's moral decay. People didn't care if his money was clean. Becoming rich made him a hero. For Boesky, the ideal partner was Milken. As an M&A engine, Milken could provide Boesky endless first-hand tips while gaining two benefits himself. On one hand, Boesky had to give Milken half his profits from these tips, disguised as service fees. On the other, Boesky's vast funds could influence stock prices to ensure Milken's hostile takeovers succeeded. Starting in 1983, Boesky and Milken spoke 2 to 3 times daily. When Boesky reached his NYC office at 7:30 a.m., Milken was already at his LA desk by 4:30 a.m. Their first order of business was calling each other. They relished that satisfaction. While they strategized intensely, most rivals were still in bed dreaming sweet dreams. Boesky's background was legendary, a pro wrestler and lifelong academic underachiever who kept dropping out. Hearing about arbitrage, he came to Wall Street to strike gold, but however, his over-the-top aggression bankrupted 2 employers. Then he borrowed money from his in-laws to start his own firm. This time he succeeded, faithfully conveying value, interpreting great books from around the world. Hello, this is Sally's Book Club. Today, I'm going to break down this book called Den of Thieves for you. Its subtitle is The Wild Rise and Fall of the Largest Insider Trading Network in American Financial History. From 1980 to 1990, that 10-year span was the golden age of American finance. Back then, the stock market kept climbing and the economy was booming. It also bred the largest financial crimes in U.S. history. A bunch of Wall Street folks leaked trade info to each other in advance, weaving this huge insider trading network to make insane profits. The collapse of this network directly led to new U.S. securities laws and indirectly caused both the 1987 U.S. market crash and Japan's 1989 stock disaster. The author James B. Stewart is a veteran journalist who's written for the New York Times and the New Yorker, known as a reporter's role model for his deep dives into major U.S. business, legal, and political events. His book, Den of Thieves, details how this insider trading network ran wild and got busted. This wasn't just one case, but multiple independent schemes by various Wall Street players. By profiling four key figures, the author shows how they got rich through insider trading, then landed behind bars. One main culprit alone paid personal fines totaling $1.3 billion. Now, what's that equivalent to? 9 billion Chinese yuan. For 20 years since publication, this book stayed relevant as the definitive read on financial crime. It won journalism's top Pulitzer Prize, made Forbes' 20 most influential business books, and got named a Fortune magazine must-read. How did these four central figures weave their insider trading web on Wall Street? How'd they walk off with at least $3 billion? And how did their empire finally crumble? Let's dive into Den of Thieves together and explore this money-grabbing frenzy. 1980s Wall Street was this freewheeling paradise of capitalism. President Reagan hated market regulations, believing any market action was justified. So financial dealings ran wild. Even when crimes happened, only one or two unlucky guys got nailed while others walked free. This bred rampant crime on Wall Street. People got bolder, with insider trading as the signature crime. That year, as Drexel's cash cow, Milken's personal fortune was conservatively estimated at $3 billion. He was likely among America's top 10 wealthiest individuals at the time. At that year's Predators Ball, nearly every American billionaire attended, including media mogul Rupert Murdoch. Some joked that bombing the venue would end America's takeover era. Did that same year Boesky's behavior shifted suddenly? He seemed disinterested in money and often vanished. One September day, aboard a luxury yacht, a friend of Boesky's was hosting a child's birthday party. Mid-celebration, Boesky dramatically descended via helicopter, stealing the show. His friend commented he's showing off too much. Boesky laughed and replied, "One thing you must admit, when I go out, I'll go out in style." The next day, he surrendered to federal authorities, becoming the Justice Department's confidential informant. Investigations had actually begun quietly long before Drexel's peak. In May 1985, Merrill Lynch's compliance department received an anonymous tip about two employees engaging in insider trading. A bank confirmed they'd opened accounts at Bahamas Roy Bank tied to 8 M&A deals. After their stock profits surfaced, the case went to SEC Enforcement Chief Gary Lynch. Just 4 months into the job, a lawyer by training, he was thorough and decisive. He discovered insider trading was epidemic on Wall Street. Average investors lost faith, and media slammed regulators as incompetent. Despite Reagan's hands-off policies, Lynch vowed to crack down, chasing every lead aggressively. His task force found the employees merely followed a Roy Bank manager, unaware of the information's source or credibility. That manager handled Levine's account, so they investigated him next. She flipped on Levine. The SEC swiftly froze Levine's Roy Bank accounts and sealed his office. This all happened before lunch. By afternoon, news spread across Wall Street, causing panic. At 7:30 p.m. that evening, Levine walked into the U.S. Attorney's office voluntarily to confess. He wore a stylish European suit, an Hermes tie, and black Gucci loafers. This starkly contrasted with the plainly dressed government workers in the office. After shaking hands, they immediately arrested Levine. He soon revealed his entire insider trading network, 4 people, and dropped the bigger fish, Boesky. Levine had constantly curried favor with Boesky, who mostly ignored him. When Levine disclosed their communications, regulators got thrilled and served Boesky a subpoena instantly. Urged by lawyers, Boesky quickly surrendered, terrified of public trial. To gain leniency, Boesky implicated Siegel and Milken. Regulators pulled a small fish from one thread, then a big fish, then near Wall Street, topping sharks. They served subpoenas to Siegel and Milken. Siegel cooperated fully, pleading guilty quickly. Before his public confession, he called his wife, parents, siblings, mentor, secretary, neighbors, even his regular cab driver to apologize. So far, the investigation had smashed through like a hot knife through butter. But with Milken, investigators hit a wall. A 4-year stalemate began. Compromise meant little to Milken now. Others could trade up by naming bigger bosses for immunity, but he had no one left above him. Milken fought back, hiring America's priciest legal team against the government and a top PR firm to remake his image. The PR firm charged at least $150,000 monthly. They rebranded Milken as Wall Street's value-creating icon, a national treasure, flooding media with exclusives and op-eds. This spin campaign actually worked. Public sentiment shifted from fury toward Milken to praise. To sway jurors, the PR team staged events, schmoozing black politicians, hosting galas for black students, playing games with 1,770 minority kids. Prosecutors were livid. They'd never faced such an arrogant defendant. Then came a new prosecutor, used to handling mafia and drug cases. He felt stuck. He believed Milken wasn't cracking because prosecutors weren't tough enough. He'd show them government muscle. They targeted a firm aiding Drexel's tax evasion. 50 agents in bulletproof vests stormed from police vehicles, raiding every office, seizing everything. In all, over 300 boxes were filled. Inside, they found recordings, evidence of violations, plus a blank conversation where employees praised each other's con artistry. Finally, the Drexel guy said, "Welcome to the world of crooks." Before, Drexel's people were united. Not one had talked. This time, the tapes pried open one employee's mouth, though he knew little about the violations. But he revealed Milken paid hush money with huge salaries, assigned personal lawyers to coach staff against the government. Following this lead, prosecutors subpoenaed a Milken inner circle member. They showed him insider trading bills bearing his signature. He was stunned. He knew nothing about these trades, clearly set up as a fall guy. In shock, he cooperated, giving prosecutors more crime intel. Prosecutors were thrilled. They knew one crack in Milken's wall of silence could make it crumble. Next to flip was Drexel's chairman. He'd believed Milken innocent until shown evidence. For years, Milken often asked if deals were legal. They usually were, building trust that he was cautious. But faced with proof, the chairman realized it was an elaborate illusion. Milken was a wolf in sheep's clothing. To save Drexel, he ousted Milken. But truthfully, Drexel didn't last long after Milken left, because junk bond theory was a scam. Data analysis showed junk bonds weren't high yield. They underperformed stocks and treasuries with terrifying risks. Before, Milken hid risks by maintaining clients to keep junk bonds circulating rapidly. After he left, some clients withdrew funds, and the holes immediately appeared. A quarter of companies that issued bonds through Drexel defaulted or went bankrupt. 5 times the industry average. Their serial defaults sparked panic. People dumped junk bonds at any price, rendering them worthless overnight. With junk bonds gone, Drexel's financial pillars collapsed. Pending mergers failed. The U.S. stock market, fueled by takeover frenzy, plunged billions overnight. Main Street investors saw savings evaporate, the economy stalled, and the nation woke from a decade-long dream. In this financial game, a few insiders became billionaires through theft and deception, while ordinary folks cleaned up their mess. By February 1990, when Drexel went bankrupt, people saw Milken as a national traitor, the epitome of the greedy decade. They blamed him for the entire economic downturn. Under pressure, Milken pled guilty to 98 charges: insider trading, false reporting, regulatory evasion, securities fraud, tax dodging, you name it. At sentencing, the judge declared, "No one, rich or poor, is above the law." Our markets have many non-wealthy investors who poured in their life savings. We cannot allow secret market manipulation. Fairness must prevail in this courtroom. Ultimately, Milken got 10 years plus a $1.3 billion fine, the largest personal penalty in history. Others in the insider ring also faced heavy fines and sentences. Levine and accomplices forfeited all assets except one house and car, getting under 2 years. Boesky paid a $100 million fine with 3 years. But honestly, their remaining assets and wealth transferred to families still guaranteed cushy retirements. Records suggest Milken kept about $1.2 billion. After prison, he remained a billionaire. So, was justice truly served? The author believes post-scandal, Wall Street was deterred. Insider trading and securities fraud dropped significantly. With 60 years since the last crisis, if the next hits 90 years later, this crackdown held immense historical value. Of the 4 main figures, only Siegel truly reinvented himself. He confessed fully, spending immense time guiding prosecutors through stock markets and untangling complex trading records. Honestly, he nearly became part of the prosecution team. Prosecutors unanimously granted leniency: 2 months imprisonment, suspended for 5 years. But the government seized all Siegel's assets, leaving him just 2 properties. This shocked him. Initially, he'd only taken $700,000 from Boesky, but he accepted it. He realized money no longer mattered. It never gave him real security. In prison, he computerized the library. After release, he launched a computer training camp at an underfunded middle school, working there full-time. For years, he had the same dream, dressed as an investment banker, entering his Harvard mentor's office. In the dream, the mentor hugs him, saying, "I forgive you, den of thieves." That's our interpretation today. Reading notes are below the audio. See you tomorrow.